Good afternoon, everyone. Today I'm chatting with Simon Quick from Canadian Copper. In today's interview, we get into the PEA that the company just put out, where Simon breaks down for us some of the costing and what the high level on the PEA is. In addition to that, we talk about the copper market, how tariffs are going to impact both explorers and developers, and Simon gives us a 12-month outlook for what we should expect out of management for the next year. All right, everybody, enjoy the interview. Simon, it's good to see you again.
Hi, Steve. Great to see you too.
So let's start off talking a little bit about copper. Now, I know the Canadian copper is more than just a copper story, as your recent PA shows. It's more of a polymetallic story, and we'll get into that in a minute. First off, I just want to talk about the general copper market, which is up 15% year to date, well, fluctuating within a fairly large range. What's your current outlook for copper?
I think it's tough to really opine on the short-term gyrations in the copper market, but if we step back maybe the longer term and we'll say this decade, I think fundamentally it looks strong. And I say that sort of number one, as we know, it's harder to find, permit, and build copper mines. Two, the ones that are operating are getting more expensive, lower grade, and having trouble meeting current supply requirements. And I think on the demand side, industrial nations more and more are needing more copper per pound per citizen. And so that really helps drive, I think, the demand side. And most importantly, I think if you look at the end users, which are the smelters, they have a really keen sense of where the current supply is sitting, and they're lowering their treatment charges kind of month by month, and that tells you that you're starting to see less supply come on stream. So if you put all those things together, I would say over the medium to long term, this decade, commodity prices, particularly copper, zinc, and lead, should do quite well.
So one of the things that you can't do an interview like this and have to ask about, and the reason that I want to ask you specifically this is because you normally give me pretty clear and concise answers, and I'm sure you put some thought into this, but the tariffs. And specifically, what I want to ask you about is how tariffs are going to impact exploration companies and development stage companies like Canadian Copper. When you think about tariffs, what are the things you sort of think about from an operating standpoint?
Yeah, I think tariffs and their effect is really acute per jurisdiction and then per stage of development. So for companies like us, we're most of focused on New Brunswick and how tariffs will impact New Brunswickers. And specifically, that province is acutely affected if these tariffs remain on as designed. Specifically, 50% of their gas is exported to the US. 98% of all of their exports within the province are exported to the US. So if things remain as is, they're forecasting 8,000 jobs lost as a result of these tariffs. And you got to remember, this is a province with 250,000 people as a working population. So that's 3%. That's significant. So I think point one, we want to see them rectified as a function of doing better for New Brunswickers. Number two, on the development side, I think most of our consumables at Canadian Copper will be sourced locally. Think fuel, cyanide, lime, but the particular bespoke equipment pieces, transformers, switch gears, things like that will probably have to be imported from the US on certain cases. So obviously we'll see some inflation pass through there, but ideally we'll see things kind of subside over the next couple of years as the new administration decides what they'd like to do on foreign trade.
So let's get into Canadian Copper because there's exciting news here. I know since the last time we spoke, you said you were going to put out a PEA, and as always, from my experience, working and chatting with Simon Quick, you always do what you say you're going to do. And now we got the PEA. It's for the Murray Brook and the Caribou projects. What can you tell us? Give us the high level overview of the PEA that our audience should know about.
Sure. So we refer to it as the combined strategy, and this really started 24 months ago. And the concept was to take two orphaned assets that have complementary needs and put them together, and really establish a baseline valuation. And specifically, that's taking the Murray Brook deposit and toll mill treating that or hauling it 13 kilometers with a newly built haul road and processing it at the currently idle on care and maintenance Caribou process plant that's permitted and ready for production. So in terms of the PA highlights themselves, it's a low capex asset. Between the two, it's less than 70 million Canadian to build, less than a 2-year payback at current prices, and has an MPV of $172 million with an IRR all after tax at around 36%. So to us, it's a smaller project, but it's a provincial permit only. and really helps leverage an asset that is about to go into care and maintenance and closure, being the process plant, and leverages our 100% owned deposit that needs a process plant. And I think when you put them together, it's really sort of creative capital allocation to get a mine up and running here in Canada soon.
In the PEA, are you guys mining from both projects?
No, we're strictly mining from an open pit. In terms of the PEA, the resource is 15 million tons and a 13-year mine life that will then feed the plants next door. So we don't intend to mine from the underground resource at Caribou to date. And then in terms of sort of the financial economics, I think it's important. Life of mine, 2+ billion in Canadian revenue and about roughly 30% EBITDA margin on a yearly operation perspective. So we're happy with the financial results.
Simon, can you give me an example of how the smelters are reacting to this environment?
I can. There's an issue that just started. If you look at Red Dog, which is the largest zinc mine globally owned by Teck, they just renegotiated their treatment charges with Korea Zinc, and we saw those reduce by more than 50%, from $165 per ton to 80, and that's lowest benchmark we've seen in almost 50 years. And that further emphasizes just the supply constraint of new mines coming on.
What can you tell us about the costing of the project?
So we report both as a zinc equivalent and a copper equivalent production scenario within the PEA because certain investors understand zinc better than copper or vice versa. So in terms of an all-in sustaining cost on copper, it's around $3.12 per pound produced. And then on the zinc equivalent, it's just under $1 per pound produced. So healthy margins there at prices we're seeing today. And we think obviously being in Canada on a jurisdictional risk perspective just gives more credence to why we think it's a sound development play.
So what sort of development timeline are you forecasting?
And so for us, we look at it as really a 3-year process from the word go. And sort of my definition of the word go would be you start the initial permitting submittal. We factored in about 12 months for that review and approval. And then the next 12 months is about team formation, contracting, starting of early works, putting together the financing package, and then production at some point in the 3rd year of that development phase. So again, pretty short compared to most of our peer group. And a lot of this is because we're able to leverage the existing infrastructure permitted facility and concentrator complex at Caribou.
Outside of the PEA and developing the project, is further exploration planned for 2025?
Yeah, we announced some exploration about a month and a half ago at an area called Murray Brook East. So if you look at a map, Murray Brook is to the left, Murray Brook East is in the middle, and then the Caribou complex is far to the right. This is an area that's been looked at for the last couple of years. Strong geochemical and geophysical signatures across a north to south area of about 8 kilometers in length. So right now, our team there is prospecting and doing some deep trenching activities to follow up on some of those refined targets. And then the objective is to drill probably 3 or 4 holes in June for a total of 1,500 meters to test some of those geophysical anomalies.
So if I'm an investor watching this, or I have you guys on my due diligence list, what should I be watching out for over the next year?
I think for us, both in parallel, step one would be to close the acquisition of Caribou, which has a $6 million price attached to it that will close in Q3. And then in parallel, we're going to begin the early permitting works. As we mentioned in our PEA announcement, we've already been engaging with the local authorities in terms of the provincial permitting requirements. So really the goal is to get all of our questions answered ahead of time before we submit the permit to make sure that there's no surprises on either end. And then we'll look to do some additional exploration, both at the deposit level that remains open east and west and at depth, and then refine some of those targets towards Murray Brook East as well. And then the objective would be in 2026, continue through the engineering phases and develop a robust project that the government can approve within the 12 months of submittal.
All right. Well, Simon, thanks very much for hopping on here. I think that this is one of the more interesting stories we got here. I always love companies that are moving towards production. The the little guy punching above their weight, as they say. So I appreciate you hopping on here, and let's keep doing this as you continue to execute on your strategy.
Thanks so much, Steve. Really appreciate the time.
All right, everybody. Thank you for watching. If you enjoyed this interview, please smash that like button, subscribe, and ring that notification bell. Also, guys, let us know what you think in the comment section. Thanks for watching, everyone.